Good morning, everybody. There we go. Hope you are all doing very, very well. Just want to start off and just say thank you for joining. I know it's December. I know most of you would much rather be listening to Mariah Carey and going to some Euro events, but I appreciate you for taking the time out of your day and choosing to discuss some market updates with us. I really, really appreciate it. Today, we're going to be continuing what we've been doing over the past couple of our quarterly webinars, where we're going to be introducing to you some of the underlying fund managers. And we've got a very exciting one this time. One of our fund managers has returned 40% this year alone. That is like extraordinary numbers. And so I'm very chuffed to have him here today to explain to us how exactly he managed to do this in what's been not the most straightforward of world, as I'm sure many of you agree. But just to kind of touch base and get you warmed up for Carl, I'm going to just give you a little quick update about what's been happening in the markets, how that's filtered through to the performance of the portfolios, and then also how our split between local and global has actually generated like quite significant performance this year so far. So before we start, and I think probably the most important slide and something we kind of use as our North Star, it's what is the purpose that we go about investing with, and that is we as a company, as Cinnabar, our goal is to empower people to achieve financial freedom so that they can choose what is important to them. And I think why this is important in Cinnabar specific context is because it's not just about having the best performing funds. Like that's almost a non-negotiable. You have to have good funds, but it's about creating sessions like this, putting things out onto our social media where we are trying to bring down, because so much happens in like on a daily basis in the markets. There's lots of news that comes out. We're trying to take all of that, kind of condense it into something that's digestible, something that you can always have at the top of your head that empowers you to feel confident about the way you're investing. And so if we can do both of that, and through forums like this, if we can do bring something that could be quite complex into something that's a little bit simpler, something that's more easily digestible, then I think we're doing our job. And so this is, like I say, our guiding light for how we want to have these kind of sessions running, and how hopefully you feel at the end of it. But like I say, it's been quite a hectic year. Everything's been shifting so quickly. It feels like every year is like this, but there is some stats to prove that this has actually been one of the more volatile years in his recent history. And I think that's kind of a cycle that's gonna keep on going. So volatility, when I talk about that, it's like the big ups and the big downs. They feel like they're a little bit steeper and a little bit higher on the upside and lower on the downside as well. But what we've seen generally is that inflation, which has been a big narrative over the past 2 years now, inflation seems to be easing, but it's uneven. It's slowing down more in one country than it might be doing in another. And so what this means is that because inflation's not completely been under control, central banks have had to say, all right, we're cutting our interest rates, which is great for growth, but it's uneven across multiple regions. And so one approach doesn't work for all regions at the same time. We've also seen huge moves in currencies. We've seen with the Rand that goes up from 17 to 18, as high as 1950 earlier in the year. We've seen that now strengthen, but other currencies like the dollar, which is supposed to be the reserve currency, has seen significant moves. It's dropped 10% this year already. And so that has a big impact on like kind of investment sentiment, but as well as like investor flows as well. And then what's kind of been the highlight this year has been the geopolitical tensions. This has underscored everything that's happened this past year. It's kind of put a risky backdrop on everything. And so those have continued to influence investor confidence. I won't say we've got to the end of a lot of those conflicts, but it does appear as if it is coming towards a place where hopefully there's less war. Hopefully the things are a little bit more predictable, but we know that that's not how things are likely to go. Fortunately, it's going to probably be a little bit more tense next year as well, as it naturally would. But what all of this has done is meant that the world has been very volatile. The markets, as a result, there's people at the end of the day, and the markets react a lot more volatile. And so it's important for us, for yourselves, as well as the fund managers that we invest into, to understand why this volatility is actually quite an opportunity. Volatility generally isn't always a bad thing. in fact, like I said, this is where opportunity comes from. Because when markets move sharply, different areas of the market don't necessarily all react the same way. And what this means is that there's opportunity for alpha. And so alpha is just kind of outperformance. There's opportunity to add value for your portfolios and for your clients' portfolios. And so what happens when these big market swings, you see the winners and the losers, that kind of separation goes up a lot more. You get the top performers shooting the lights out, and you get those that are lagging. Those end up trading quite far behind. And so what this means is that over the long term, they'll converge because they all have similar growth trajectories. But there's a mispricing because naturally those ones that goes up tend to come down afterwards. And the same as ones who haven't done that well tend to do a bit better in the period to follow. And so this mispricing gives an opportunity for active managers to pick up bargains. And so we've generally, across all of our portfolios, been increasing our exposure to active managers. And we see this just by looking at the banking sector in South Africa. We see how this volatility kind of plays through through the years. You see that for the most part, the bank that's at the top will not continue to be at the top. And so to buy the top might mean that you buy the worst in the next period. And you get this kind of consistent across all asset classes. But I thought it was just interesting to show that if you had gone and invested into Standard Bank, if you had known that they were going to be the best performer, you would have got 28%. On the other hand, if you had known that Nedbank was going to be the worst, you would have lost just under 1%. A year back, 2024, Standard Bank did 14% and Nedbank did 40%. So there's a lot of volatility, and rightly so, it can make you or your clients feel quite uncomfortable because it means that the market no longer, or it doesn't move in a straight line, that there is going to be this ups and downs. But naturally, more variety, there's more movement, and ultimately it's easier, or not easier, but there's more opportunities to find to invest into. But what I want to do today is kind of get a sentiment before we start looking at what's been happening locally. I'd like to just put up a quick poll for those of you here. If you can just please have a look and vote. I just want to get the screen up. What we want to ask for today is, sorry, I'm just looking for it. It is. All right. What we want to find out from you all today is how are you currently feeling about the state of South Africa? So be as honest, it's you can either go from positive all the way through to negative, but kind of how are you feeling about the current situation in South Africa, all that's happened? Generally, are you quite positive, or are you more negative? I'll give you like another 10, 15 seconds to answer because it's very interesting to see how people are kind of feeling. All right, there's it's good to see that so far we've only got one negative. A lot of people leaning towards cautiously positive, which I mean is completely, and that aligns exactly with what we're saying. So I'm glad that most of you are positive. I see there's one fully positive and one fully negative. Nice. All right, a couple more seconds. Awesome. There we go. There it is. Yeah. 67% of you are cautiously positive, which I mean, that's exactly how I describe Cinnabar as well. So it's good to hear that most of you are like that. I know there's been so much happening. It feels like we're so close. And I think that's something that's inherently South African is it feels like we're so close to achieving something really, really meaningful and great in this country. But then we get hamstrung by something, some government flaw like that. That kind of pulls us back to reality. But I mentioned now that cautiously positive is similar to how we feel about South Africa, where South Africa has actually provided quite a stable anchor for our investment portfolios as well. We're seeing inflation has been under control, so it's now at 3.6% for the year or over the past year. This is within the Reserve Bank, so they target between 2 and 4%. And this is a lower inflation target than what's happened previously, which is really awesome for stimulating or it takes the pressure off of households and businesses because prices aren't increasing as much anymore. On the back of this, we saw South Africa's central bank, the Reserve Bank, maintain some of its strong credibility throughout, and that stability has anchored expectations going forward. Their kind of insistence on making sure that interest rates are not cut down too early to avoid inflation kind of spiking again has helped. And we've now entered into what is more of a rate cutting cycle. And so this naturally just improves the confidence and also aids in planning for the local economy because things are a little bit more clear. And then most recently, South Africa being removed from the grey list. This is one of the big uncertainties that has been hanging over South Africa and stopped a lot of foreign business actually flowing into the country. This being removed off of this list has actually removed one of these big uncertainties and naturally improved sentiment and should result in some more flows coming into the country. And so whilst the rand has remained volatile, as it always does, South African equities have shown remarkable resilience this past year. Specific sectors have really done incredible returns, and a large part of that is why the Cinnabar funds have also done quite well. But through all of the resilience that's shown, South Africa has actually been one of the more calmer markets compared to many of its other alternatives. And so altogether, these factors playing into each other have actually provided quite a supportive backdrop for our local portfolios. And so why this lower inflation is actually better for you, or why all of this actually has better influence on your portfolios, it's because lower inflation naturally means that your value of your rands is kept stronger. If you earn 10%, inflation is now 4% as opposed to it being previously 6%. You've now earned an extra 2%. And so the minimum level to actually grow your capital into the future beyond what inflation is eroding from you actually helps with a lower inflation rate. As a result, with the stable interest rates, a lot of the investment certainty is taken out of the picture now. There's a lot more confidence that can go into the market, and naturally, as a client or an advisor, it makes planning and investing a lot easier because you know what the future looks like a little bit more. Importantly, with the rand being so volatile and moving as much as it does, if you have a good split of your local and offshore portfolios, the rand weakening versus global markets strengthening, they actually end up countering each other out. And so naturally, you get a little bit more diversification in your portfolio. And then compared to many other markets in the world, it seems to be a little bit more predictable in South Africa at the moment, and it's giving us a slightly calmer backdrop. And so if we look at the performance of the local funds, there's been two real main drivers as to why as to show you why we've done quite well. The first was the added value through our SA equity exposure. Because of the environment that we've got, that we've been in, SA equities have historically been quite cheap. And so although they are still considered relatively cheap, we've seen significant performance coming out of South African equities. It's been one of the best performing stock markets on the globe, as well as because of those conditions we spoke about with the stable or the lower interest rates, as well as inflation coming down, it's been quite supportive for growth assets generally. And which is all of this has meant that our funds have done incredibly well year to date. All of them outperforming their peer group averages on the local side of things, with the balance plus the moderately aggressive portfolio being the standout performer, almost 20% up this year. And so performance has really been boosted. This as well as how SA bonds have also done quite well, have boosted the portfolio performance. But it's important to zoom out because we often get tracked in how South Africa doing, and is that directly influencing how our funds are doing? It's often important to look at what's happening globally because that is often more of it has a bigger effect on South Africa in general. And at the moment, there's a couple of forces that are shaping how markets are moving at the moment. The main is we've been seeing shifting leadership across regions. The US largely had been doing very well and has been leading thanks to strong earnings, as well as a lot of liquidity, which means a lot of money flowing into America still has boosted that economy as well. The picture in Europe is slightly more mixed. They're struggling for growth, but there are some selected bright spots in countries. But generally, Europe's struggling to get their economy really powering through, like was initially expected at the start of the year. And emerging markets as a whole, for the most part, are improving. But again, it's pockets. There's a lot of dispersion. Some emerging markets doing great, others are not doing so well. And Japan as well, they've been lagging as well. So they've got, similar to South Africa, nice valuations, but they haven't got that momentum that's driving the markets forward. And so what all of this is doing is it's creating wide gaps, valuation gaps, and that's creating opportunity, as we touched on earlier, because of these disparities that over the long term kind of play out and end up at the same point. Because of this, there's opportunity for active managers to benefit from this dispersion. And this is the kind of environment where active managers really add value. And so as a whole, having the global funds as part of the key building blocks in the Cinnabar portfolios has actually been quite complementary to the fund's performance. Because of how we manage these portfolios, where we go and we diversify across style, so we'll have a growth, value, quality bucket. We've seen that because of our growth, the blended approach, what you get is you get really strong performance across the curve. So we've had growth managers, we've had value, and we've had quality managers. Our growth managers have generally captured the upside in your tech companies, your innovation companies, and that resilience has really boosted the performance there and led it to being one of our greatest supporters or drivers of returns this year. Our quality managers, and these are managers that protect on the downside. So I'm sure we've seen there's been some fear mongering as soon as some of the stock markets drop 10% or so. That's where these portfolios start doing well, because they invest into your strong quality companies that have got massive competitive advantages. That mean they're kind of protected from what's happening. And so they protect on the downside. And then our value managers continue to find opportunities in areas that's often overlooked and it's been oversold. And so as markets recover, they naturally do better. But the key point from all of this is that because of our spreading out of risk and our selective spreading out of risk across the styles, like I mentioned, your growth, value, quality styles, we aren't relying on one type of outcome. And I think that's probably one of the key takeaways from this session, is that to make a bet on one or the other outcome means you either win or you lose. And sometimes losing is definitely worse. It feels a lot worse than winning does, unfortunately. And so what we do is we try to build a portfolio that captures most of the upside, but takes out the absolute worst case scenario. And so our global portfolios have been complementary to our local funds and smoothed out performance quite a bit, which are really happy with. And so bringing it all together, there's a clear narrative that's emerged this year. Global markets have been very volatile. South Africa's been a little bit more stable. And so that balance of global volatility, South African stability has created quite a surprisingly balanced opportunity set for local portfolios. Because of our managers and how they invest, each one added value at different times. And so that diversification has helped us smooth out the overall experience for the portfolios and gave us more ways to capture the returns. So all of this sets the stage for the next part of today's session, where we are going to have a look at one of our more high conviction strategies. And so this fund delivered around 40% returns, and it shows really what is possible if you have specialist management with the right environment. So this kind of portfolio, it's going to be a high conviction approach. So it's not something that we'd ever include fully into or ever include high allocations to in our portfolios, because it's a very concentrated, intentionally concentrated bet that's supposed to shine when markets are more volatile. And hence the reason why it's done so incredibly well over the past year. And so I'm not going to go into the details now of how this performance was generated, but what I'd rather like to do today is introduce you to two faces, two exceptional investment minds. Those of you who are regulars with the Cinnabar Quarterlies, you might recognize them. But we've got two members here, Carl and Adam. Both are members of the investment committee, and two people that I'm privileged to work with on a daily basis. Carl, he's managed everything from unit trust to hedge strategies. He founded his first asset management company at the age of 26, which is incredible. He served as CIO Chief Investment Officer at Sasfin, and also won the JSE Innovation Award. And so he's the person behind this high conviction strategy that delivered 40%. Joining him is Mr. Adam Balkan. Adam is a Kaya charter holder with over 20 years of experience across London, Monte Carlo, and South Africa. He's led global portfolios and manager research at Sanlam Multi-Managers, and he's got a strong track record of consistently delivering peer-beating performance. So we're in very, very, very good company today. So gentlemen, over to you.
Thank you so much.
Thank you so much.
opportunity.
Okay, thank you, Cameron. Oh, welcome, Adam. Uh, I'm excited to show everyone how we achieved our stellar return on the, on the Tiger Worldwide Balanced Worldwide Flexible Fund. And hopefully, after this presentation, everyone will understand how we managed to achieve this and how we plan to continue producing returns like this going forward. So, just to explain how we invest, we're a high conviction macro fund. That means we take very concentrated bets. We don't try to own everything. We express a small number of big long-term themes driven by geopolitics, reserve shifts, and resource security. This leads us toward real and monetary assets such as gold miners and selected energy exposures. And as Cameron mentioned, it's a complementary strategy. We take a multi-year approach, not a quarterly one, where we hold many of our positions for several years in a row. Um, and it's really designed to complement the traditional equity holdings, the passive core or a big broad equity core. So just to explain how we invest, we start with the big picture. We look at structural trends, things like the weaponization of trade, de-dollarization, or resource scarcity. And we express those views through very focused exposures in things like metals, miners, energy, and a small set of themes where we have a very clear view of what we believe is going to happen going forward. And we think in really multi-year scenarios. It's very much taking bets and then waiting long term for them to play out. We manage risk not through trading or buying and selling, but by limiting the size of what we want to take at each type of area we want to be exposed to. And we're also very clear about what would be, what would make us change our mind. Like we believe this trend is going that far. What are the signs we'll need to say, okay, that trend is not working out. Maybe it's time to change it and remove that trend. So as we said, this is a high conviction fund. So it's a very small number of bets. So when it performs really well. So it's really a satellite. It performs very differently, especially in times of stress compared to your average fund. That's why it works so nice to actually complement and um, perform when other funds don't perform. So over the last year, we haven't been investing in a calm rules-based world. We've been investing in a world where economic weapons have been used, economic tools are being used as weapons. Just in the last few months, we've seen so many things happening. We've seen the rare earth export controls, chip seizures, um, refinery explosions. That just, three of the biggest refineries that took Russian crude in Europe mysteriously exploded. We've seen new rounds of sanctions, nuclear tests. The US finally started. It's restarted nuclear testing. The Russia showed off its brand new nuclear system. You have open talk of regime change. The US is getting close to Venezuela, and being very clear that they're not interested in just talking. They actually want to go and change things there. And basically, the general supply chain weaponization between happening, as you've seen, both between the US and China and all the reshoring that's been happening. Now, all of these events would have dominated, the tariffs as well. Yeah, all of these events normally would have been a global headline in its own, just in a quieter era, where that's everything anybody would have been talking about. But now they're happening simultaneously, all at the same time. And that's a type of environment that this fund is specifically designed for. And the result of that approach has been strong. As you can see, our performance has been fantastic this year. We're already up 40% year to date, and we're the top performing fund in our category. The fund's about 3 years old. We've done very well. We're still way ahead of our competitors there and the averages over the 3 years as well as the 1 year. And just to look at what are the specific shares that have really helped us. I mean, the biggest drivers have been the meaningful allocation to gold miners, uranium, and some select energy names. So those are exactly the process, the themes that our processes are built to capture. You can see the Anglo Ashanti just on the year to date, it's already done 253%. The three big gold mining shares there, Goldfields and Harmony, also up nearly 200% and 125% for Harmony. Also, we've done very well out of things like chemical, which is uranium and platinum as well. They've also added substantially to our performance. So why have they performed so well? Is what suddenly made Anglo Gold shoot up 250% in a year. So let's actually just look at the gold price. As you can see, the gold price itself has outperformed all other asset classes, including US stocks and US bonds, global stocks for the last 25 years by quite a significant amount if you look at the graph there. And why is that? It's really a case of the monetary regime is shifting from a dollar reserve era to something closer to what I call a gold reserve era. For decades, the world has stored its wealth in US dollars. After the West froze Russia's reserves back in 2022, many countries realized that dollars can be seized by foreign governments. Now, central banks are rapidly buying gold instead because it can't be printed or sanctioned. So, as you can see, central banks have been buying gold at record levels. So before the great financial crisis, central banks were selling gold every year at quite a large amounts. And that's all changed after the GFC. But what really happened is after 2022, you can see it suddenly kicked up there where they started buying around 1,000 tons a year. So part of what this really shows is that isn't speculative investment. It's a strategic move by the most informed and long-term holding investors. So as dollar reserves decline and gold reserves rise, you can see a slow but unmistakable diversification away from sole reliance on the US dollar. If you continue these trends, you can see in the last few years how the US dollar has been falling and the gold price has been rising. If it keeps on these trend rates and this graph's actually only to June, it doesn't have a massive kick up in the gold, which might make it sooner. At these trend rates here, it was looking like the US dollar would fall below gold as the world's primary reserve currency in about 3 years, might even be a bit sooner at this rate. So there you can see a very clear shift how the world is de-dollarizing and moving away from the dollar. But what's interesting is why did it have such a big kick this year? Before 2024, most of the gold ETFs were primary sellers. So while central banks were buying, it was actually the ETFs that were selling large amounts of gold to them. But as you can see, since the beginning of 2024, ETFs have been buying, and they've been providing a powerful force behind gold's current rally this year. And with extreme demand starting to happen in the third quarter of this year, which obviously showed up in the sudden markup of the sudden run up in the gold price. Just in the last quarter alone, gold-backed ETFs bought over 222 tons, almost about the same as all central banks combined. And we expect this ETF buying to continue because, as you can see, the fiscal situation in the Fed is still very difficult. That means they're spending a lot more than they're earning. They're running a deficit of roughly 8% of GDP, which is, as the same size they were doing during World War II. And at the same time, despite some signs of inflationary pressure, the rates, traders are we're still looking at about a 70% chance of a rate cut, later this December. And, demand's not only coming now from central banks, pension funds and long-term holders of gold, retail holders of gold, it's also coming from some unusual sources. Here you see Tether, the largest stable coin. That's now they've bought up to now about 116 tons of gold so far. That makes them actually bigger than a whole bunch of central banks in terms of their holdings. You can see just in the third quarter, they bought 24 tons, which is bigger than even China, Brazil, some of the biggest buyers of central banks. So gold's starting to be accumulated by real long-term holders now. And, just to get it a little bit into why that is the case, it's, one of the big shocks that I mentioned before that happened was in 2022 when, when Europe and the US decided to seize Russia's state reserves or freeze it, put it that way. So they froze the state reserves. It was about $300 billion worth of US treasuries. So up till now, reserves, if you held reserves of another country as a central bank, those reserves are always going to be neutral, apolitical, and safe. But suddenly, and for the first time, that became a political tool. And every central bank in the world suddenly came to the realization that if they get on the wrong side of America, all of their US dollars can easily be seized too. And not only are they frozen, but there's a lot of discussion now that they could actually be taken and, for example, given to Ukraine to rebuild Ukraine. Now, regardless of whatever moral issues, whether that's right or wrong, that changes international law and international standards that have existed since, for decades. If your sovereign bonds, a country's bonds and assets that they own can be frozen or seized, they're not safe, they're exposed. Whereas gold held in their own vaults cannot be frozen or seized. And that single moment dramatically accelerated the move towards gold as the reserve asset that countries will trust the most. So, yeah, so now we're in the so when gold moves this much, we start questioning, is it just a rally or is it something deeper? As I said before, we believe this is structural because it's happening for reasons that aren't going to go away. Firstly, as I mentioned before, you have these huge fiscal debt pressures. Governments are spending far more than they can. You've now got, in a more volatile world and a more conflict-driven world, increasing defense, increasing infrastructure costs as there's reshoring. So we're seeing more weakness of paper money. Money is debasing. And that's been a trend, as you saw in the gold price for a while, but it's really accelerating now. Secondly, it's that the resource or the reserve diversification, where central banks are needing to buy gold now because they need to move away from the US dollar. Because even if you're a friend of the US, it doesn't mean that things might not change. You can imagine Saudi Arabia thinking, now we're friends, what if things change? So, just on a normal risk management, they have to buy gold. So you've got these massive buyers that are there, and they need to continue this trend regardless of the price of gold. And thirdly, And thirdly, once again, gold can't be frozen or seized. It's a safe, independent one, and that's what everybody needs. You need assets that can't be printed away and they can't be seized. So taking these primary forces together, gold and gold miners aren't a short-term trade. Yes, they've run a lot now and they might pull back a bit, but we believe this is a structural trend because it's a strategic hedge in a world that you need to have, where a lot of what used to be, everybody moving to bonds as a safe haven isn't does not work as well when a lot of the shift is geopolitical and structural like this. So, has gold run too far? Well, if you look at, it's had a very strong move and it is a volatile asset. So expect that volatility. But if you look at the past there, long-term buyers, central banks, emerging market savers, they're buying every dip. In the past, if you look at the 70s, the last time gold went up, it repriced over years, not months. Our job isn't to call the exact top, it's to make sure that you own the hedge when the regime is changing. If we follow a similar way to 1970, 1980, now remember, this isn't the end of the world, it's just a change in regime shift, as we had in the in the 70s again, when we moved away from the gold standard in the early 70s and then moved into an inflationary environment afterwards. You can see there, gold's, if it was to carry on these levels, gold would still increase another 6 times in price. Now, we're not going to say it's going to do exactly that. I mean, the world's things are different, but you can see there's lots of upside in potential for gold given the structural forces behind it at the moment. And I believe we really are at the beginning of a long-term bull trend that is going to take gold a lot higher than it is at the moment. And that's part of why we're keeping that hedge in there. So just to sum up, the world has changed. The reserve system is changing with it, and this fund is positioned for that reality, not the old reality, the old world we used to live in. So I'll stop here for now and invite Adam to join me. Welcome, Adam. So he can ask some questions and he can go deeper, not only into what I've talked about gold, but perhaps some of the other structural themes we've been finding opportunity in.
Thank you.
Thank you, Adam. Let me
Thank you,
stop
Colin.
sharing.
It really, it really was interesting. Um, maybe to before we move on to some other questions, just sticking on gold for a little bit of a while. So, uh, the structural trend is very clear, but we even saw in that 1979 to 1980 graph that there is some there was some volatility during that time. Do you worry, that some of the ETF flow, some of the flow from, for example, cryptocurrencies like stablecoin, are bringing a bit of too much speculation, a bit too much froth to the market? And if you do, are you just going to power through that volatility, or are there any ways that you think about in terms of levels or triggers with respect to the position that you hold in gold?
Well, that's exactly that. I do agree with you that now that you're getting more participants in there that are not as structural holders, I mean, they are taking it on a structural basis, but generally they are people with weaker hands than, say, a central bank that'll buy that gold and absolutely not ever sell it again. So there is that froth in it, and gold has performed exceptionally well. And some of the gold miners, which are, we hold a lot of gold miners too. I mean, they've done, as you saw, Anglo Gold, they just this year alone has done 250%. So in that case, there is a lot of, there is a good chance of a pullback. And at positions like that, um, we do look at actually reducing our position. We won't completely get out of it because once again, things could turn at any moment, and once they go up, to actually time it that well, it's not so easy.
Yeah,
Like I can see it's a good structural trend, and once again, this is something we're holding for a long period of time. So what we do is we size our bets.
right.
When we've had a big run like this, we pull back to more reasonable, what I would say, lower levels. Yes, it might hurt our return going forward, but there is gold can easily, and you saw in those charts, pull back another 20, 25, 30% even, and still be in a long-term structural bull market.
Yes.
But that 30% can be painful if it's just if you're getting, you don't want to sit through that. So that we are sizing it back there. Um, remember, gold works very differently from other commodities. If you look at something like for copper, imagine a bathtub. The way copper or oil, work is you've got you've got taps of new supply coming in from mining or that new from mining. You've got a level in the bathtub, and then you've got a drain at the end, which is what's being used, say, oil in cars. And if it runs out too much on one side, if there's more demand than there is supply, then the price goes up, and if there's more supply than demand, the price goes down. And that's pretty much how commodities work. Gold is different than that. Is that there isn't really a plug. As gold is mined, it just stays. It just keeps filling up more and more. So it works on stock, not flow. So the only price of gold is determined, and it's similar to Bitcoin, which people understand more because there isn't really that much. Bitcoin doesn't end really so much. I mean, people forget they lose their keys in that, but generally it's a set amount of stock. So its price is purely based on demand. On how much people are going to prepare to more people selling or more people buying. And at this case, most funds in the world are very underweight gold. It's one of its lowest ratios in history, even at these high levels to the stock market that it's been for decades. So there's a lot new participants that are going to move into gold, never mind the structural ones that keep buying it up. And I mean, we've seen some interesting stuff even recently. There's been reports that China itself has been actually unofficially buying as much as 5 to 10 times as much gold as it has officially been, as it's officially been announcing. If that's the case, then I'm not going to go too much into currency wars because that'll take up the rest of this conversation. To talk about how China's planning to create almost a competitor currency to the US dollar, being gold based, because people generally won't trust the Chinese central bank, but they're prepared to trust gold. So they've just made it very easy to swap rubles or rupees on the Shanghai Gold Exchange back and forth to gold, trying to have a separate network from the dollar network. Um,
Carl, before we get on too much
yeah,
down the rabbit hole of gold, and there are
yeah.
some Q&A questions coming on from the audience. I do want to move on to some of the almost more important drivers that are symptomatic or maybe even causal to what's happening with gold. But before we get to that, we've got two questions. Firstly, what has been the trend on crypto sovereign reserves? If you have any comment on that. And secondly, to what extent do you believe that silver will follow or perhaps exceed this gold trend? And obviously, we know that silver has also been a very strong commodity this year.
Okay, well, I'll answer the silver one quickly because that's a quick answer. Is yes, I believe it is that. That's a silver does tend to follow gold a lot. It's a much more. It's very much followed by retail investors, so it tends to be a lot more volatile.
Mm.
So silver is something that I think, has now broken forward, and I think it might go a lot higher because it tends to follow gold ratio, but it's really followed by retail guys, almost if you want to call it the Reddit guy, lots of day traders. So it's extremely volatile. It's one of those things that can move up and down a
Yeah.
lot more.
But
So
it is linked to gold.
it is linked to gold. It's not something we've played in. We have a bit of silver positioning, but small because it's a lot more volatility and
Yeah.
not as much as I'd. It's not a structural shift. It's not something I can feel secure that I can go to bed now and know in 5 years' time I'm going to wake up and it's going to be many, many times higher than it is now, which I do feel with gold.
Silver also has some industrial use,
Yes.
and so there also are some economic cycle aspects to what drives silver, and it's a market that is a bit narrower, a bit more controlled, as you've said, Cole, in terms of traders, and so it's a little bit, as you said, a bit more difficult to really predict those long-term trends. There's a couple of questions on we're getting into this. A lot of questions. We're getting into this crypto
Okay.
question. We're getting into
Well, let me,
the
yeah,
AI
let me,
bubble, and are we in a correction there? Let's answer those questions because I think they're important. I do want to get back to the larger the larger shift.
okay.
If you can try and keep your answers a little bit brief, Cole. So
Okay, I'll keep them shorter. Well, then
AI
just on
bubble
crypto.
and crypto, yeah.
Yeah. So, crypto, it's interesting. The US is counteracting this gold effect and it's been interesting with the stablecoin legislation. Just to tell everybody quickly, they put out legislation about 2 months ago in the US, the state called the Genius Act, where essentially you're allowed to issue where institutions can issue stable coins as long as they're fully invested in US treasuries. Now, stable coins, just for people who don't know, that is effectively a blockchain. So it uses blockchain rather than central clearing like we use in a banking or the SWIFT system. It uses a blockchain to have a dollar that's then backed it's basically, the way I always like to describe, it's like having a money market fund that you can transact with. So you've got say you've bought a money market unit trust, but you can now take those units and buy things with those units and sell things and pay with those units, all on a blockchain. So it becomes a very efficient way of moving money. Now, I don't have time. We don't have time today for me to go into a lot of the effects of that and how it's going to affect the banking system because it's a massive change to the banking system, probably the biggest one since Bretton Woods. It's a whole shift. But it's been very effective at creating treasury demand, which has been a good. I mean, I think they've got about $300 billion has moved into stable coins, moved into treasuries via stablecoin issuance since they signed that act. So it's almost like the US is fighting China with technology. We're going to put the stable coin and use that network as a transactional currency, where China's moving for a gold one. So that's yeah, don't have time to get into that in detail because to build everything up is another hour's conversation. So we'll have to do that another time. But I can explain a bit about those capital wars and how that's influencing everything. But yeah,
Yeah.
so yeah, in terms of crypto, there's a little bit that's going to be held as reserves. It's still mainly a speculative asset at this point, which is why it's so super volatile. So it's not quite a reserve currency yet, but it's going to move in that way going forward.
Okay.
Okay, I'll keep that short.
Thank you. So it looks, Cam, it looks like we might have to have another session because we are already running against the clock. But let me bring in these questions. Some of the questions have been relating to the theme and what is going to happen to the US repo rate or the South African repo rate. Look, let's shift a little towards almost a bigger part of the picture and what is really happening here. And obviously, you touched on it with respect to what the adventurism of Russia. And essentially, what we're seeing is a breakup of the post-war, actually, probably more realistically, the post 80s geopolitical scenario where the US was by far and away the strongest geopolitical force. And there were very few rivals, or there were no rivals that could really dominate geopolitics like the US did. And in that environment, there was what is termed Pax Americana. In other words, a peace or a political order driven by the states. And that had long term, that historically had some deep roots. I mean, you've touched on Bretton Woods. and the fact that the US was and remains for now the reserve currency. So it wasn't just didn't just happen from the 80s, but when Russia fell, you had like quite a dominant force. Obviously, we can see that that's breaking down now, and you have rivals in China, you have rivals in Russia, you have rivals in the Middle East, and you can see a bit of a breakup of what's happening in the world. How does that call impact on other themes that you are playing in the fund? How do you see other drivers and what's happening and how do you play those?
Okay, well, essentially that move away from, as you called it, that's unipolarity, where the US was the strongest, to multipolarity. Um, that is something I think the US has now become very aware of. I think under previous administrations, they were acting like they weren't, but I think they've become very aware of how vulnerable they are to things like China, how dependent they are on those. Um, and, so to be able to, I mean, the biggest thing you're seeing right now is like the US going to Venezuela. Now I suspect this, I don't know because I'm not like plugged in any way politically, but I suspect some grand bargain has been made between, the US, Russia, and China, where the US has been saying, okay, we're moving out of your areas. So maybe you can take, the China, you can take control of Taiwan at some point, and uh, Russia, we'll push for a deal in Ukraine where you can at least get out of that war, without losing too much. And consequently, you do not interfere with Venezuela and stay out of our backyard. The US is moving away from trying to control the rest of the world as much because it's realizing it can't afford to, it's not succeeding in it. I mean, it's been a disaster in the last few times it went to, Iran and Afghanistan, I mean, Iraq and Afghanistan and all of that. So it's going to go to where it matters the most to it, which is Venezuela, which has the largest proven oil reserves in the world, far bigger than Saudi Arabia even. It's in its backyard, and that's always been supported by both Russia and China. And you've seen they've gone conspicuously silent as the US has started to, it's almost regime change, the beginning of its regime changing there, where it's starting to bomb. You'll see probably in the next few weeks some special forces and specifically bombing of initially cartel ones. We're not talking they'll bomb the presidential palace just yet, but that's probably on its way. I mean, you saw Maduro even offered to Trump that I'll become a client state, and he said no. They're not even prepared to do that. They don't want a deal. They want full control, and that's so you can see the US is now moving away from, its policeman of the world thing and going straight to, what's in its own national interest in its own backyard. And that's going to creates more conflict in the world, lots of things to look out for. I mean, what happens to Nvidia if China takes Taiwan? Now, how do they handle that type of thing? Nvidia, the whole AI and everything is based on that type of thing. So these are things you really got to pay attention to because, you know, as somebody mentioned to me once, people always used to be worried about PMI. That's the purchasing managers index. What is happening to the economy? Are people buying or selling more? You know, how companies. Nobody even talks about that anymore because it's all become a lot less relevant over these big geopolitical moves.
Hmm.
So those are the risks we try to hedge out on, and specifically in those ones. So this fund is specifically designed to hedge for what happens if those things come to pass. Now, it might
Yeah.
not come to pass, so you want to, obviously hedge your bets. But there are other areas, as you mentioned, that we've been into. I mean, the biggest one now has got to be energy. I mean, that's part of why they're going into Venezuela because energy independence, is pretty much the most important thing you have. I mean, a lot of what China's doing has been to control its energy. I mean, they're building more nuclear power stations than the rest of the world combined, and
Yeah.
they have been for
And
a while. I mean,
you mentioned, Carl, in that respect, you mentioned technology, and somebody on the Q&A asked about AI, and that's part of it, right? Part of this war, part of this Cold War, let's say, part of this preparation for being a geopolitical power is technology. It's not only driven by commercials; it's driven by almost survival. As a powerful
yeah,
state, you have to have technology, and with technology comes power demand, comes electricity. AI farms, chip farms, technology, all of that becomes more of a national interest. Can you
yeah,
talk about that in terms of positioning? You mentioned uranium and this nuclear build out.
yes. So even before the AI and the technology side of things, we were quite positive on uranium because it was in supply deficit. Even looking at what exactly was needed going forward, um, you know, there wasn't enough uranium to be able to supply what was needed for nuclear power stations going forward. And that means the price was going to rise very much. Now, the uranium price the actual price of uranium in operating a nuclear power station is like less than 3% of the cost. And there's only about 60 buyers in the whole world of uranium. So it's not a big market. So the price can go up, double, triple, go up a few times, and it's not going to really worry them too much. I mean, they're nuclear engineers. Their biggest concern is to make sure that they have enough fuel at the time. So as a result of that, we've been in uranium now for many years, and it's been a very good performer for us. The AI build out has dramatically increased it as everybody's realized that there's nowhere close to enough energy to do that. But keep in mind, it takes 10 years to build a nuclear power plant. So the nuclear is not going to be able to solve the AI problem now. It will in the future,
Right.
and you can see, everything changed, from nuclear not being able to, get a new one built for like nearly 50 years in the US. Suddenly now all the legislation's changed, all the old people in charge were fired, the new people put in place, and now permitting is allowing nuclear power stations everywhere. So they're going to start building. So you're going to see nuclear power stations being built everywhere because of the clean energy revolution. Nuclear was considered unclean. Now it's obviously switched now because people have
Yeah.
realized they need it. So you're seeing a big push on that. So nuclear has now almost, and uranium as a result, has now almost become a bit part of the AI trade, which means
Yeah.
it's a little bit less of a hedge if AI was to collapse right now because a lot of the guys in AI have been going into it. But I believe the true energy win or the true energy winners for AI is going to be natural gas because there you can build a power station very, very quickly. Doesn't take 10 years, it takes a couple of years. In fact, there's some guys out there like Bloom Energy, they can deliver basically a they can deliver, what do they call those things, fuel cells, hydrogen, natural gas fuel cells, oxide fuel cells in 90 days. So
Amazing.
yeah, so those guys are able to put energy very quickly there, and you can see the people in the US are starting to get upset because everywhere a data center has gone up, electricity prices have tripled and quadrupled. So you're really starting to get
Yeah.
that not in my backyard thing. So electricity prices have to come down. It's becoming a political situation. The only way to do that at any rate of speed in the US is by natural gas. So we've invested in some natural gas gas producers on that one. Um,
Yeah.
I did say, I'll be honest, I missed the turbines because gas turbines, all of those guys have gone up like a few 100% this last year. As some of I mean, most of them are booked out to like 2028, 2000, 2030 in terms of gas turbines.
These are
But,
all little many themes that one misses, and what just focusing on
okay,
the bigger one. So
yes,
it's very interesting to hear that, Carl. Maybe
okay.
final one for me, and I know again we are running against the clock as I've said. Um, Carl, in terms of inflation, all of these things, sound inflationary, and yet inflation seems to be under control, and we mustn't forget, I suppose, that the US consumer is still 60-70% of the drivers of the US economy. Do you worry about inflation?
Yes, I am very concerned that we're going to see inflation. Um, Keep in mind, as I said, the US deficit is something like 8% a year. So that means the US money supply, because all of that ends up being printed, because that's basically more money that's coming in that's going out. So they have to essentially print that money to,
Mm.
on an annual basis. So without any other expenditure, ignoring all of the massive spending they'll need for defense and infrastructure just currently, every year everything goes up 8% relatively, in terms of dollars, but that's everything. So a lot of it's going to other things, not necessarily stuff, because once again, China keeps making stuff cheaper and cheaper. Um, so you're seeing the inflation really show up in things like healthcare, housing costs, and service costs, childcare, those type of things have been massive in the US. And actually generally in the rest of the world as well. I mean, we see that type of stuff here.
Right,
It's like your flat screen TV is not that much more expensive than it used to be, but everything else is a lot more
right.
expensive than it used to be.
And
And
before the audience starts only getting concerned about the states, I mean, debt to GDP ratios and debt growth in national governments is not an American problem. It's a global problem.
it's everywhere,
China included. So
even worse than the US if you look at the debt
yeah.
to GDP, it's far
Yeah,
worse.
yeah. So these problems or these themes are not US focused. You can't run away by hating on America and going to other places. They exist everywhere,
Yeah.
and we think about them globally. Carl, I think maybe Cameron should we should have another session because I mean we barely touched the surface in terms of some of these themes. It's been very interesting. Thanks for the opportunity to speak to those Q&A questions we didn't get to. If there were any, we will respond. Thanks for the opportunity, Carl. Thank you, Cameron. Hopefully, it's been interesting to the audience as it has been to myself.
No, I think it's potentially been too interesting. We've got Richard saying need more of this content in the newsletter, please. So you guys, I've got some extra work for you to do on Sundays now when we're prepping that newsletter. But no, genuinely, thank you for joining us, Carl and Adam. I think the to the audience is something I just like to say to them. Like I've been working with them now for well, Carl for a bit longer, but Adam also quite recently. These two are probably one of the most clever people I've ever met. And so it's a privilege to have them at a session like today. So hopefully you got some insights from today's session. They are yeah, like I say, integral into the future of this company. So you'll definitely be hearing a lot more of them today. And then so to the rest of the audience, I just want to say thank you. Thank you for joining us today. You can start turning on your Michael Bublé, your Mariah Carey now. And don't and remember, calories don't count over this Christmas period as well. So that's what the New Year's resolutions are for. So if there is anything else, you can reach out to any of us if there are further questions. There are some questions we didn't get to, so which we'll do that after the session. But yeah, thank you so much for joining, everyone. We'll see you again in the new year. You must have a safe festive period, and yeah, good luck with the last couple of weeks of work. All right, cheers, everyone.
Thank you,
Thank you.
guys. All
Thank
the
you so
best.
much.
Be
Cheers.
safe over the holiday
You
season.
too.
Bye.